Who will be alpha in a beta world? When oceans are warmer, cities smarter, and intelligence is artificial. At Barclays, we've been asking big questions for over 300 years, bringing strength and stability, scale and reach to a changing world. Looking beyond wealth to see what really matters in our clients' lives. And seizing the opportunities that count. Today is a race to the future. The winners will have answers so big the questions change. Thinkers and challengers who see beyond tomorrow to see a brilliant world.
Hello and welcome to this discussion, which is the final part of our Greater China series, proudly produced with Barclays Private Bank. This is the 5th edition of this series. So far, we've covered topics such as succession planning for clients in PRC, succession planning for clients in the rest of Southeast Asia, Hong Kong and Singapore. We've also covered private wealth disputes, ESG and sustainable investment. It's been a terrific series, and we are finishing on a peak here today with Asian investment into the UK. There's some terrific trends which we're going to talk about today, which revolve around high net worth clients investing in the UK, particularly London. We are going to hand over shortly to Martin Hill, who's going to lead us through a conversation that's going to bring you the latest stats from the market, both residential and commercial. We're going to cover some of the legal aspects of structuring these deals and the experience from the coalface of a number of advisors. And finally, we're also going to cover an overview of the credit market, particularly looking at the commercial sector. So we're all set for a terrific discussion today. And I'd like to hand over now to Martin Hill from Barclays Private Bank in London, who's going to lead us through the conversation today. So over to you, Martin.
Thank you, David. So it's quite a wide topic, as David just said. So I think it probably makes sense to get straight into it. So Charles, if I can start with you. With you being a member of the private clients team at Knight Frank, can you just start by giving a bit of an overview in terms of how you see the market at the moment?
Absolutely. Thanks, Martin. I mean, look, property's in the headlines all the time at the moment, and even the Office of National Statistics analysed which industries and sectors were the most resilient under the pandemic. And interestingly, property has come in at second behind education, but sitting above essential retail. And there's other really positive headlines, such as this morning, the total value of UK homes sold so far this year has doubled from last year. But clearly the last 12 months have been quite polarized, depending on which sector. In most sectors, there's been these key themes in terms of decentralization in both office and residential. What is the future of the high street? What is going to be the impact on landlords or student housing operators? And the same for retirement living or care homes. So every sector has been affected in one way or another. But there's been some record performance, and then others feeling the impact of COVID-19. Starting on residential, in summary, it's been pretty solid performance across the board, looking at 2020, and that was helped by the government's allowance for the property sector to remain open for business. As ever, whenever there's uncertainty, there's been a flight to quality. So grade A locations, both in the major cities and also regionally, have been the most attractive. And lockdown one fundamentally created a huge amount of pent-up demand, which was buoyed further by the stamp duty holidays in the core market. That, paired with a lot of liquidity swashing around and a willingness to invest into real assets, has created this competitive environment. Going back one further, let's not forget we had 4 to 5 years of political uncertainty in the form of Brexit and the general election, which held back other buyers making their decisions. So interestingly, COVID-19 has created a reason to overlook stamp duty, which were some of the frictional costs that perhaps prevented buyers from making quick decisions previously. And there's been this reassessment of how people want to live. As people have been spending a lot more time at home, it's prompted them to really consider what's important. Is that extra bedroom required? Do you want a garden? And of course, it's driven certain markets. So in London specifically, the house market has been very hot as people seek their own front door, garden, privacy, separation from other neighbours, and the prime country market as well, which has probably been the most active ever since 2007. And I can see that continuing, moving forward as well. City centre apartments throughout the UK have not posted quite as strong results, but I think that's partially due to the international disruption in terms of travel to the UK. But still prices have held firm, and that's been supported by simply a lack of stock. Looking in terms of the data, we've just looked at how 2020 compared to the 5-year average running beforehand, and I think this paints quite a good but anecdotal reason for the competitive market we're seeing. Prospective buyers, in terms of people registering with us to buy a property, is up 32% above the 5-year average. And in the super prime residential space, so buyers prepared to spend £10 million or more, that's doubled. So 110% up on the 5-year average. Offers accepted in the same scenario is up 26%. And I suppose the key statistic here is stock level. In terms of property we're bringing to the market, it's 13% down on the 5-year average. And that's for a number of reasons, and I'll touch on a few of those later. But really, we have stock holding back the market at the moment, and that's true as well. I'll touch on in the commercial market as well, in the office space. As a result of this competitive environment, it's no surprise most residential agencies recorded record month of March ever since 2007. So in terms of the volume of transactions happening across the UK. And then looking forward, and I think this is where buyers are seeing the opportunity, is most of the research houses are predicting between 20 and 25% growth in house prices over the next 5 years. And that's following 4 to 5 years of negative house price growth. So quite quickly, you can draw the conclusion that the market has perhaps bottomed out and there are the right platform now to enjoy that growth. Touching a little bit on Asia in terms of what in the future could buoy that even more. We're yet to probably see the full impact of the BNO passports in terms of the route into the UK. There's a lot of people asking questions of us in our China, Hong Kong, Singapore offices, generally looking at the UK. But I think later this year, we will see more buyers who are new entrants into the market taking advantage of the BNO route. And we'll start to see that translate into real-time data. So that will be an interesting one to watch, and that might spur on even more activity in both London and the regional cities such as Birmingham and Manchester. Sort of shifting on to offices, on the occupier front, headline rents have been relatively stable. There's probably been a little bit of negative growth of around £1 to £5 per square foot. But where landlords are being clever are just in terms of the incentives in terms of rent-free periods and encourage longer leases. Where this is put rents in certainly the West End in Grade A office space, so a typical floor will now be around £110 per square foot, ranging up to a top end of more than £150 per foot if you're in a new purpose-built building on a garden square. And I think there was this assumption that offices would be one of the worst hit by COVID-19. It's been a really interesting environment to operate around, because actually it's caused this reassessment, similar to residential, about how businesses use their space. And certainly in the corporate world, you're seeing a reassessment of how much space and personal space in terms of desk space that an employee must have. And that is going in the direction of providing more space, and then also breakout areas and more relaxation areas within the office. So encouraging people to come to the office. And that's amidst the backdrop of actually quite a starved market in terms of available square feet in the best areas of the cities. Paired with that, we're seeing a move as well towards more new purpose-built office blocks where people can take a whole floor plate to have a bit more privacy. The newer the building, the better the air filtration systems, bigger lifts, more lifts, and then well-being facilities within the building as well. So creating quite a competitive market in that 5,000 square foot floor plate market in grade A offices. Talking more, I suppose, about direct investment, so actual transactions for office buildings, that was very subdued from when COVID-19 hit the UK. And for that first 9 months, the volume of transactions did drop off. Interestingly, a lot of investors' strategies changed instantly to more of an aggressive, opportunistic and discount-driven strategy. And there just really wasn't much of that. A lot of the office buildings and commercial buildings in London are held by private capital. There wasn't the sort of pressure to entertain discounts or offload. So and at the same time, a lot of the insurance money and sovereign funds shied away from direct investment and moved into REITs. And we're now seeing 12 months later that capital coming back into the market, still within those REITs. So specifically looking at Asia and Hong Kong even more so. In the commercial investment space in both the city and the West End, we're seeing the Hong Kong REITs being very active. What that translates in terms of how it impacts the market is REITs will typically look for the higher yielding to get their cash on cash targets buildings. So that's fantastic for those trying to offload larger buildings. But where the private capital operates in that space, typically in the 10 to 75 million pound lot size range and will be willing to pay sharper yields, it's very hard to give confidence to sellers at the moment that we're with the airports closed and travel restricted, that we're going to be able to get the same amount of buyers through the door as perhaps last year. And that leads on to, I suppose, the real logistical issue, which is viewing buildings. And we're really seeing three routes to transacting at the moment. Full remote due diligence. And there's been some examples such as K&K and Sun Ventures who have bought big transactions without actually visiting the building, but they know London incredibly well. The second route would be to employ a third-party asset manager as a trusted advisor to do a lot of the due diligence on the ground, or JV, so joint venturing, where we're seeing this more commonly come into this space rather than taking outright control of a building, looking to joint venture with a partner that has a different skill set or greater knowledge in London. And actually this point leads quite well to what I was saying about the REITs being most active, especially in Hong Kong. There's been a recent change in some of the REIT codes, which will now allow for participation and joint venture into deals as opposed to just acquiring outright, and as well as some de-restricting in terms of providing development finance in these sort of commercial spaces as well. So I think the big story for the next 12 months is going to be the activity from the propcos and REITs coming into the London market. Sure. But still, this is being held back by stock.
So you talk about stock. There was quite a bit in the news this week in the UK about the City of London and planning permission being granted to convert existing office space into residential. So what do you think the impacts will be there?
I think moving back historically, there's always been a lot of discussion about repurposing, and I don't think it's ever really come through in fruition. I think it's a great way of, it's a great solution for the problem, which is we just don't have enough housing. It will be very interesting to see which building owners and are willing to go down that route in terms of repurposing and going to residential. I've tend to find that most that have employed capital into the City of London in particular are looking for long-term income, more of a legacy investment, treating it almost as bond-like income, as opposed to necessarily the capital growth. So it will be a really interesting space to watch, and I think the market will welcome more residential space in that location, especially coming from Asia. But still quite early, I think, to see what will happen.
Sure. And I suppose just to finish up on that point, what are you seeing that's really bringing Asian investors into London in terms of the trend? So you've mentioned the REITs, but what about when it comes to the ultra high net worth clients? Are you seeing more activity in the lifestyle area of the market, or more activity in the investment side?
We're seeing more of a lifestyle-led investment, actually. Our wealth report, which is an annual flagship report that we release, which analyzes flows and trends of wealth, has an attitude survey. So we spoke earlier this year to 1,000 ultra high net worth individuals based around Asia, and we just asked simple questions in terms of what are the main drivers for buying residential property, not necessarily exclusively in the UK, but globally. And 28% of ultra high net worth based in Asia said it was to upgrade the family's main residence. 21% was for a holiday home, and 20% was a permanent move to another country. And in terms of the driver for the permanent move to another country, for mainland China, 40% cited education as the primary reason, and that was actually slightly higher in Hong Kong-based ultra high net worth individuals at 50%. And what I'm seeing on the ground is very much the investment and lifestyle type property is very much based around education. It's one of the UK's greatest exports, so if I can call it that way. And it's a key driver, and that will also drive locations in terms of which people are buying property in London or outside of London to be near to those schools. As well as our attitude survey, just interestingly, sorry, Martin, I know you asked about residential, in terms of what Asian-based investors are looking for. Offices were typically the preferred asset class. That was sort of 30% of our data came back as offices, and then that was followed by healthcare and retirement living at just under 30%. And typically, we're seeing the investment side come much more into the commercial space, as I say, offices, healthcare, logistics, as well, and more in terms of the private rented sector, which performed very well in terms of rents being received under the pandemic. But I think for the next 12 months, the activity we'll see is going to be in the residential space is more lifestyle. So perhaps slightly higher capital values, looking at setting up base for family and for schooling reasons.
Sure, great. Well, that's Charles, thank you very much. That's probably a good point to ask Leona a couple of questions, because you've touched on a point there that I know overlaps quite well with her expertise. So, Leona, thank you for joining us today. As somebody who works as a real estate lawyer, and I know you have a large amount of expertise in commercial real estate, Charles's point around 30% of their clients looking towards real estate in the UK, specifically being focused in the commercial space. How does that match with what you're seeing?
I think it rather depends on which audience we're talking about and the clients that we're working with. If we put aside the big propcos and the big REITs from Asia that have been investing in commercial real estate, most of the family offices that we work with, most of the ultra high net worths that we work with, usually their starting point will be something in the residential space, for the same reasons that Charles mentioned. Many buying homes here in the UK, usually because they have family, children coming to university here, or indeed they have been to university or been educated or spent time here in the UK and want to have a second home here. So we very much see that happening in the family office space. And again, just to tie back to what Charles was saying, and we did read your survey, Charles, and there's an awful lot that came out in that we're actually seeing happen, because very often what's reported on doesn't necessarily transpire in what's actually happening transactionally. I think Brexit did cause a wobble. There's no doubt about that. In terms of prior to that, we were seen as a politically stable, transparent legal system and a transparent tax system. I think there was definitely some discombobulation when we decided to come out of Europe. What that meant was a pause in the residential market, I would say. But again, what we have seen is more and more capital looking to buy homes. So in the last 6 months, we bought a significant number of private residences, both in central London, also out of London. There's been certainly a flight to some of the higher quality properties in some of the Oxfordshire and Gloucestershire parts of the country. So we've definitely seen that. We've definitely seen that mirrored. I think that now that things have settled down post Brexit, there is very much a sense of normality, i.e. we're looking at still the same legal system, which is transparent. The UK legal system has always supported foreign investment, foreign ownership. We don't have a history of trying to repatriate or in any way deal with foreign investors differently. Yes, there have been some changes in the stamp duty regime, and that's probably one of the priority areas that when most families are investing, they want to look at what the upfront costs are for them and what's the best way for them to enter the market. We often say to clients, find the right asset first, and then we will look at how we structure that, not just from a tax perspective, but also what you want to achieve as a family. Is there an intention, for example, to set up a trust so that future generations benefit from those properties? And also, we need to understand whether this is a series of investments, which will determine what sort of structure we use, and equally, whether this is a one-off transaction. So all of those component parts, I think, would support what we've been seeing in the residential space. Turning to the commercial space, so again, I would echo what Charles has said. It's probably fair to say that central London offices, and indeed Manchester and Leeds, have seen significant money go into those cities as well, have been the asset class of choice. Again, not just for the REITs, we've seen a number of family offices create what we call club deals, where they collaborate together to pool their capital to buy some significant assets here in the UK. But it's also fair to say that we've seen some of that capital now looking at some of the alternative asset classes. I say alternative, they're not alternatives in that sense of the word. They've got proven track record, as Charles and the Knight Frank team will attest to. We've seen a significant amount of money being deployed into the student accommodation arena. Again, it's a preferred asset class. It's got track record now. The university system here, which Charles touched on, is very much driving that decision making. If, like me, you're of a generation where when you went to university, and even if you are living in Asia now and you were educated here in the 80s and 90s, the student accommodation that you were used to then is not what the students expect now. Much of it looks like a five-star hotel. And so we've seen a significant amount of interest in student accommodation. Again, it's solid bond type income, particularly if it's university backed. And we've seen a number of the REITs from the region investing in that very heavily, with a view to actually launching that as a special REIT on the Singapore or Hong Kong stock exchanges, because there's a feeling that there's appetite for that. Probably the other asset class that has become an asset class of choice, again, driven by the pandemic, is logistics. The move in the UK and Europe to online retailing existed way before the pandemic. Everybody's seen what has happened to the likes of, Amazon. Alibaba obviously is a well-known brand in Asia and that, would be competing with an Amazon. And again, we've seen a significant amount of money chasing logistics. Charles will have the numbers, but the yields on logistics have just sharpened unbelievably because of the quantity of capital that is coming into the market. One of the things that I think we saw at the beginning of the pandemic was people looking for opportunity. Was there going to be a discounting opportunity, as there was immediately after the Brexit vote? Our house view was that that wasn't likely to come, for the reason that Charles talked about. There's still a lot of capital looking to be invested in the UK and Europe, but also, and I'm sure Ben will touch on this, there's a huge amount of liquidity in the lending market. So we didn't feel that the position here in the UK mirrored what was happening during the GFC, where the lack of liquidity was creating disruption, if you like, and providing discounting opportunities. So unfortunately, for a lot of our clients based in Asia, that window just simply didn't come about. And again, we saw a lot of capital deployed at the end of 2020 in that last quarter. Whilst it wasn't at the levels pre-pandemic, there was a significant uplift in the amount of capital looking for a home. And I think I heard a stat that there is still 40 billion of worldwide equity that is looking to be deployed in some form of real estate investment here in the UK.
Yeah, it's interesting because both yourself and Charles have mentioned Brexit, which feels like a long time ago now from the referendum, but it's still fresh in people's minds. I spoke to a client this week who, just before Brexit, had started to build a UK portfolio of property. And the reasons they chose the UK was because it had a stable political environment, it had a stable currency, and they felt they understood it. And he said since then, the currency devalued by 30%, and we've had 3 different prime ministers since he bought the first property. So it was quite interesting to see that when you put it in that context of what the UK has been through, added with the pandemic. His thoughts this week were really that now is the time to start adding into that portfolio again, because he felt a lot of the issues that had held off from him investing further were no longer on the table. So I would agree that there's certainly a lot of pent-up demand globally, and specifically within Asia, we're seeing a lot of that. You touched briefly on tax, and that's obviously an important consideration when you look at the various structures that you've spoken about. So we all know about the changes that we've seen in stamp duty. What are the other considerations that people need to be thinking about from a tax perspective when they're looking at either commercial or residential property in the UK at the moment?
Okay, Martin, I'm going to fess up. I am a real estate lawyer and therefore not a tax specialist. So it's going to be above my pay grade, but I'm going to attempt to answer some of that. But I certainly have colleagues in my private client team who are well versed with working with family offices who are looking to make investments. Apart from the entry taxes, which everybody's familiar with, I think one of the things that we need to consider very early on, and would encourage clients to get advice on early on, is what are the tax issues that are going to impact you during the time that you hold the asset? Because however long you hold the asset for, there needs to be a consideration of that. And it's important to understand what that hold period might look like. Not definitively, because very often people don't know how long they're going to hold an asset, but certainly there's a different set of considerations if it is going to be a short-term hold, because we have to have an eye to exit, and all of that informs what sort of structure we might use to acquire the property. It will make a difference in terms of whether it's residential or commercial. And also for those on the webinar who are listening, I'm sure everybody knows that at the moment, holding assets in a Jersey, Guernsey or offshore vehicle where you sell the shares in that particular entity is stamp duty free. We know that the UK government, the HMRC, are looking at that. The draft legislation has already been prepared, and we fully anticipate, certainly in one of the forthcoming budget announcements, for that playing field to be leveled. So the bonus, if you like, or the upside of holding assets in offshore entities and trading the shares as opposed to the asset may well disappear. And obviously, we now also in the commercial space need to be thinking about what capital gains are sitting in a vehicle where you are buying shares. So there are a number of tax considerations. But as I say, as a non-tax expert, I'm sure there are far better tax experts on the call today. I'm not going to go above my pay grade.
Sure. And we'll come on to Ben in a moment on the credit side, but from your perspective, what have you seen on the availability of debt and the demand for debt on the property that Asian clients are buying in the UK?
It's been an interesting period, actually, because certainly 10, 12 years ago, when I first started working with investors from outside the UK and predominantly based in Asia, most of them would borrow locally from their relationship banks. Those relationships massively important to them and still continue to be. I'm hoping that Ben will concur with this when he speaks later on. I would say that in the last 3 to 5 years, we've seen a significant shift in that not only is there a plethora of debt available from UK-based lenders, but actually those lenders are massively knowledgeable in terms of the market here, and actually are now highly competitive, even when comparing them with the local relationship lenders. So we've certainly seen far more of our clients wanting to look at what the debt options are, not necessarily precluding their relationship lenders, but very often looking to work with lenders based here in the UK. We've also seen banks combining, lenders combining, syndicating together. So perhaps the relationship lender based in Hong Kong syndicating and working with one of the UK-based lenders, which probably is the best outcome for from the client's perspective. But ultimately, there's plenty of debt available. It's about actually thinking about who's the right lender for the asset that you're buying, and equally what your long-term aspirations are. Building that relationship with your lender here in the UK, we often say to clients, is just as important as building your relationships locally with your local banks.
Yeah, I would echo that. We've certainly seen a large increase in syndicated loans, especially on some of the more complex transactions that involve things like hotels or significant offices. Great, Leona, thank you. And this is probably a good time to bring you in from a credit perspective. So your role within Barclays is as the head of our debt structuring team. So you probably have you're probably best positioned out of the panel to provide a bit of an overview in terms of the commercial real estate lending markets over the last year or so.
Yeah, sure. Good morning. So I'll touch on 2020. Obviously a pivotal year that none of us will forget, predominantly for the wrong reasons. But look, UK commercial real estate lending fell kind of 23% in 2020. And the suggestion is that going forward over the next 2 to 5 years, it will in large part be a little bit more expensive, probably require further capital from the borrowers than they're necessarily used to. And that stat and forecast is from the recent commercial real estate report produced by the Business School, or formerly known as CAS. But obviously, always, it's worth delving into the details. The reality is that even though lending was down 23%, the majority of that was relating to refinancing and loan extensions. Obviously, as you would expect, transactional flow in the commercial world was actually pretty benign for obvious reasons. Margins were typically up, anything from 20 to 80 basis points. And that was really on the back of the perceived or the actual increase in risk relating to various sectors, but also the increase in wholesale funding costs that banks suffered. And if I think back to kind of April, May, that was the spike that we saw, anything from 50 to 75 basis points increase in a bank's funding costs. Now, as you look to the borrower and that contract between bank and lender and borrower, actually overall finance costs for them, on the basis that they were a floating rate borrower, probably weren't too dissimilar. LIBOR came down circa 50 basis points on a 3-month basis. So actually the overall finance costs that the borrower was experiencing was not too dissimilar. It was effectively gone from effectively a LIBOR basis onto a margin for a bank. But as I say, their actual wholesale funding costs went up commensurately as well. Average LTVs were probably in the low 50s. That again is slightly down on a historical basis. And what we really saw was in Q2 in particular, a market dislocation and paralysis that was very short term. It wasn't relating to the global financial crisis of 2008-9, which Leonie referenced, which was more systemic. and much more longer in duration. In fact, 2020 played out a little bit in a funding capacity wise that mirrored the COVID situation. So wholesale funding costs did come down in Q3 and 4. Banks and lenders re-entered the market, were willing to consider new conquest opportunities. But that's not the case across all sectors. As you would expect with any significant external shock, there were some winners, so to speak, logistics, last mile that again, Leona mentioned, but actually the fall guys were pretty much retail across the board. So availability for financing of things like high street retail, shopping centres is exceptionally limited. It's estimated that actually out of a survey of 50 active lenders at the moment, only 3 would be willing to consider lending against shopping centres. Personally, I find that even surprising. I don't really suspect, unless it's a very benign leverage, a very worthwhile client, that actually people are willing to extend credit against that sector. The downside risk is just too much. It has structural problems. They are going to be a long-term solution needed. And so banks just wouldn't want to unnecessarily expose themselves from that perspective. So as you would expect, liquidity and debt appetite often reflect the sentiment of the buyer community of principals. And beds and sheds remain at the forefront of that. Logistics, in particular, as Leona said, commands yields that are institutional, are way beneath where they've ever been before. And actually, they're forecast to remain so. Why? Because people just can see continual evolution towards that sector, towards increased demand, towards potential rental growth. You probably can't see that at the moment in any other asset class per se. So, it'll be interesting to see as the global recovery comes from COVID, how real estate as an asset class is considered by owners, by occupiers, and I guess by lenders as well. Many lenders historically have viewed real estate through a bricks and mortar lens, the capital value, the location. Others, such as Barclays, we consider it through a cash flow, a quality and a quantity of yield. Can that debt structure sustain itself through the cycle? Covenants tend to try and drive assets performance these days, not just LTV and look back ICR, but more debt yield. And so we're seeing a trend, a continuing trend more towards that basis. And I think that will inevitably need to cater for what will probably become an office sector, which is much more akin to the continental model, shorter lease lengths. People do not want to tie themselves into incredibly long leases. There are accounting implications, as well as, what has hit us in the last 12 months, where people are reevaluating what they want from an office. And I absolutely agree with Charles. Corporates are happy to spend money on rent, but what they want to do is get quality now for their cash. They want an absolutely incredibly flexible office. Well-being is at the forefront of that. Extra space, the quality. So, I think, again, secondary locations, secondary quality may well suffer, both from a capital value perspective, but also a liquidity perspective. But as I say, versus the general financial crisis of 2008 and 9, banks are well capitalized. Their loan books are in a pretty healthy state from a leverage perspective. You've got pretty stable yields, albeit on the lack of transaction flow. So I do think lending margins will potentially remain slightly higher in 2021 and go forward position. But they would slightly reduce, in my view, as the economy starts to recover, as the government schemes run off, and how GDP and unemployment relate to that. Lloyds Banking Group came out this morning with good quality results. They're now expecting GDP of 5% versus 3% previously, and that unemployment will probably peak at 7%, not 8%. That is a massive difference versus probably 6 months ago. And as the banks report in the next week or so, you are seeing a lot of these provisions start to be released. Not all of them, just a portion of those, but it's a good bellwether as to how banks are seeing liquidity, the market that they face off to, both domestic and internationally. So I guess in conclusion, I think it's a pause and wait and see mentality. But as Leona said, there is still huge liquidity in the market, and that can cater for accepting shopping centres or high street retail. It can cater pretty much for any asset class and almost, any expectation of leverage. Now, clearing banks play in a certain part of the capital structure because they are almost forced to regulatory because of the capital they need to hold against certain loans. But there is other liquidity that can pick up that slack: debt funds, pension funds, insurers, etc. So, I mean, look, in conclusion, I think if you are coming to the UK, position yourselves as best as you possibly can. Surround yourself with good quality advisors. Be clear about your strategy, the business plan you've got for the asset, and your longer term objectives. Lenders will support best those that can demonstrate that, articulate it coherently, and ultimately it will save yourself money in terms of the margins that they then would apply.
Sure. And in terms of bank appetite for credit around commercial property, how does that vary between London and the other regions of the UK?
So I think it's fair to say that international banks will always focus on London and maybe the more major dominant regional cities that have been spoken about: Birmingham, Manchester, Leeds, etc. It tends to be quite fickle which institutions will go north of the border into Scotland, but Glasgow and Edinburgh have always historically traded very well. But you do see a huge number of what would always have been Asian relationship banks following clients on a kind of ad hoc basis. There's two things. One, Leona's right. UK, European banks are more than happy to face off to Asian clients now because the Asian clients themselves are more global. They've got a footprint in the UK and they are indicating that they're here for the longer term. So naturally, a domestic bank that also has international ambitions wants to pick up some of that demand. Equally, international banks are setting up in the UK, and they have teams and capability to even house domestic clients. It's still uncommon for that to be the case, but I think they also recognise that their business is best served not to be totally reliant on Asian capital flowing in, but also have a domestic stance as well. What we are seeing is that a lot of clients internationally like a UK institution on the ticket, so to speak. And that is in part to give them credibility, to vouch for sometimes for what they're buying, and also to take up the opportunity to work with partner clients. I think the other aspect of that is that, following the global financial crisis of 2008 and 9, banks just do not write significant single tickets anymore. The days of banks writing out £100 million plus single ticket check, certainly for the UK banks are probably gone. And therefore there is club style structures in place now that are a lot more commonplace than usual.
Great. And I know your expertise is mainly on the commercial side, but just briefly to end, what's your view on the availability of credit more towards the residential market and how that's going to look for the next 12 months?
I think, that is what within the private bank we deal with in, day out. So, the reality is that I would even describe the liquidity for residential lending as better than commercial. It is taken obviously more on a location, on a market basis. But Savills and Knight Frank are obviously projecting further price rises. We as an institution have very strong appetite for residential lending, be it mortgages or buy to let, or even development finance. There is good quality and very competitive marketplace for good LTVs, 60, 70%, and you're looking at less than 2% all in as a cost, and that's anything from 2 to 5 years. So, the reality is that banks themselves see the stable, the secure, the sustainable nature of residential lending, and they're happy to place those assets onto the book. some of the stats that we've got is, in the £10 million plus sector, there's typically 100 transactions per annum. And we would expect half of those to be funded by mortgages, and let's say half of those to be funded at a kind of 50% loan to value. So, the reality is there's kind of £500 million as a general rule of thumb in terms of mortgage availability or mortgage quantum needed in that segment. But I see good, strong competitive tension, throughout the market, and I don't see that being subdued into 21 or 22 or 23. As Charles and Leona have alluded to, the demand for residential has evolved. Houses more than flats at the moment, out in country rather than purely city centre. But ultimately, London will always stand tall. It's coveted internationally as a safe haven for capital. People do allude to the political environment, the economy, the stable legal system. It is pretty much unrivaled. And when you have flows of international capital coming in on the back of education, then I think it's here to stay.
Great, Ben. Thank you very much, David. I think
if I can just.
Please, Charles.
Yeah.
Sorry, I think I'm a bit slow on the Wi-Fi. It was really just to support what Ben was saying. I think actually in the last 24 months, it might be higher than 50% in terms of in that 10 million plus space in terms of the amount of debt being used. I think buyers, I've found in my personal experience, buyers are coming over with the intention, whether it be London's a great defensive asset class versus other, investments around the world, or whether it's actually not being well versed around it, think that the loan to values would be far lower, the rates be far higher, or not aware of the perhaps inheritance tax considerations around buying property. So buyers that start, or even a currency play, but buyers I found that have started off with great liquidity could easily buy a property cash. By actually reaching the point of exchange, opt for putting some form of debt, mortgage into the property. So I think it's probably a little bit higher than that. It was just to add on to Ben's point.
Thanks very much. There is time to get a question in. Do put it in the Q&A or the chat. There's a question from Charles Innes, which I think has been answered through the panel, which is foreign buyers looking outside of London, north of the border. I think we covered that one off. So I've got one up my sleeve, which is, we talked about the importance of education as a driver for residential property investment, but also investment in the student housing sector. I mean, how do the panel think, how robust is the education sector post-COVID? We've gone for this flip to virtual. Do you think that actually increases demand because people are still going to send children to school and university in the UK, but perhaps they need to put a bigger base down in the UK, so more of a footprint actually buy property? How do you see the new world playing out? Will more people stay at home to do their education from abroad? I mean, Martin, do you have a view on how robust the education sector is as a magnet for wealth and investment in the UK?
Yeah, I mean, I agree with that. I think Charles said it's still one of the biggest exports we have as a country, and I would absolutely agree with that. I think if you look across Asia, there is still a demand within the ultra-high net worth client space for their children to either be educated at a top university in the UK, the US, or in some cases in Australia now as well. We're seeing more from mainland China. So there absolutely is that desire. We tend to find that depending on the university where the children are attending, the parents would always like to have a base either close to that university or within London, so they know they can spend time with the family outside of that. It's not just university as well, though. There's a large number of our clients' children attend some of the top schools here, like Eton as an example. So it is a big impact on that, and I think more as well. I think it really depends on the individual countries within Asia. So we tend to see a lot of people in Hong Kong specifically were educated in the UK themselves and have a real desire for their children to be educated here, whereas in other parts of Asia, more like say Indonesia or Singapore, there tends to be more of a leaning towards the US in some cases. So it is a bit of a mix, but it still is it's a big draw towards property and people spending more time here because of that.
And I imagine, Martin, you see a lot of those people who study in the UK staying here, setting up businesses, putting down roots. Obviously, plenty will return to Asia to go on and have their careers. But do you see a good proportion remaining in the UK and investing from here?
We do. We also see a mix. So what tends to happen is people will get some experience here, and then it really depends on how the family's wealth was acquired. So if there's a big family business in Asia, they may spend a few years in the UK or other parts of Europe trying to gain experience in various sectors that may add value to the family business. And then once they have that experience from outside of the family, return to Asia to take up a role within the country. Tends to be quite a well-trodden path, but we've seen quite a bit over the last few years of children who are attending universities like Oxford or Cambridge, as an example, who have absolutely stayed on, and especially around Cambridge with the tech startup scene in that area, children doing their own things and starting up their own businesses. And that as an area, the property prices and the value of real estate around Cambridge, both for commercial and residential, has been, it's grown significantly because of that.
Fascinating, thank you. Leona, do you have a perspective on the education sector and how it's going to have to adapt to this virtual world but remain a magnet for this country?
I do, and that's driven by the fact that we have a very big student accommodation practice. So we act for a number of the providers and developers of student accommodation. And whilst it's true to say at the beginning of the pandemic, obviously all the students had to go home and there was a big concern about how that asset class would perform. That was very much seen as one semester, if you like. A lot of universities went back, a lot of students went back, and actually a lot of foreign students, when they were able to fly back into the country, did so isolated and then have been at university, at their student accommodation close to their university. So actually, having seen the student accommodation income drop off, we've now seen that coming back up to about 75–80%, which if you'd asked us that a year ago, everybody would have said not in a million years. I think Martin's absolutely right. It's not just the universities. We have a number of families who have children at boarding school here, who have bought homes literally in the last couple of months, so that when they're on exeats or when they're at the end of their school term and they want to come on holiday, rather than having to fly back to Hong Kong or Singapore or indeed China, they stay here in the UK and they stay with either their parents or their grandparents. So we've seen a significant move to that lifestyle piece. It's also fair to say, and I don't know whether the other panelists have seen this as well, whilst the US and the UK have always vied for students because they've had fantastic university in each of those countries, there's been a move certainly amongst the Asian clients that we work with, just feeling that the US perhaps, and obviously they have a new president now, but certainly there was a sense that it wasn't as welcoming as it was previously. And so many of those have looked at the UK, whereas they may have looked at the US initially. I think also it's fair to say the tax system, again, I'm going somewhere where it's above my pay grade, but the tax system in the US is even more complex than the UK. And actually very often getting your capital out or your income out can be a real challenge. So those sort of considerations are now being factored into. If we're going to make a long-term investment in real estate to support education, let's think about where that might suit us longer term.
Perfect. We've got a number of questions in the Q&A, so I'm just going to bring those out now. So question from David Waterhouse. I'm going to bring Charles Penny on this first of all. Is there a greater or lesser demand in the last year for off-plan residential rather than assets that are already there for people to see and feel and touch? Charles, how's the off-plan market been affected?
It's a really good question, and it's a little difficult to answer in one go. Trying to break it down into price points. Let's say that we have your off-plan investment in areas of identified capital growth, whether it be Crossrail led, further infrastructure led, or Centre of London across the board, £500,000 up to £2 million. That's still been quite robust. Typically how developers access that market is through exhibitions actually in the destination city, whether that be Singapore, Beijing, Shanghai, Hong Kong. That has become less prolific. So I'd say the volume has come off, but it's still been quite robust. Again, there's been a bit of a flight to quality. So even at that level of the market, it's finding the as close as you can get to grade A location at a price which feels right. We've seen quite a bit of investment move to the regional cities. So very good product that's coming on in Birmingham and Manchester, just to name two, is perhaps taking some of the market away from Greater London. Moving above that level into the £2-3 million per apartment upward space, it's definitely come off a bit. Buyers want to be able to have the tangible experience of walking around a building, seeing the quality. So I think the volume has come down a bit, but what might exaggerate that is actually the pipeline of construction and development startups has been far lower than it has been. This started back in around 2014, and Ben might be able to interject here in terms of shying away from providing development finance or underwriting values at over £4,000 or £5,000 per square foot. Now, there was some private capital or sovereign wealth that came in to bankroll these developments, but loosely speaking, that so in access to that sort of funding and the lack of available plots for building within central London has reduced the amount of stock in the market. So that it's a bit of a dual function of the both, which is seeing a bit of a lower volume. But speaking on behalf of Knight Frank, in the last 6 months, we've seen single unit transactions well over £20 million, which have been done virtually and off plan. So that's why I said it's difficult to put a blanket around the whole market. It comes down to personal preference and I suppose where you sit on the risk curve in terms of what you're prepared to do and invest.
Thanks. Ben, do you have anything to add on to that?
Well, I think I'd just add that, obviously when you're buying something off plan, it doesn't exist. And therefore, when you have something like COVID, naturally that wouldn't necessarily impact it as much as, secondary sales, and it's been explained to me by a number of agents that, sales above £5 million, typically are difficult to achieve virtually. It's that price point. People are happy to take a view, perhaps less than £5 million. And if they know London or they know the block of flats and they have friends or associates that have one already. But as soon as you go past that point, people want to see it and touch it. And obviously in an off-plan world, that's just not physically possible. And so people are already in a psyche where they can get their head around that and they will consider it. COVID hasn't impacted it, so to speak. But absolutely agree with Charles. It's a function of how much speculative development has started, will start, the availability of land, etc. The huge swathe of development that has taken place in recent years is obviously 9 Elms. I think the majority of that is now coming to completion. It will be interesting to see how much of those that have been bought off plan actually complete. The expectation is always very high, but as we saw in the global financial crisis, actual completions versus what was bought off plan somewhat differed. So it'd be interesting to see whether that macro picture does influence that area. But I certainly concur that there's good, strong demand for things that are always infrastructure led, and I'm a big proponent of that. Let somebody else pay for the improvement in the area that you're going to buy in. I think it's always something to bear in mind when you're looking to acquire something new in an area you don't necessarily know. Is it being regenerated? Are government putting in funding from a central perspective? And obviously Crossrail and the high-speed rail between London and Birmingham are the two biggest infrastructure projects that have led that.
Okay, thanks. And Leona, how do you see it from your side, perhaps working with developers, bring these new schemes to market? Does your experience reflect Charles and Ben's thoughts on where trends are?
Well, Ben's just touched on something that is very close to our heart. So we're working and have been working for a number of years on the redevelopment of the Battersea Power Station site. And obviously that is not too far away now from completing, i.e. the power station itself. And that is very much an infrastructure-led project, much of which was sold off plan. So a critical point for us now on that development in terms of how many of the pre-sold apartments, which are in some cases very significant in size and value, to the more what I would call the everyday end of the market. It will be interesting to see how many of those do complete, albeit that those have been funded through a deposit scheme. In terms of what we are seeing in terms of new development, and Charles touched on this earlier, and I'd be quite interested, even if it's offline, Charles, to talk about it, is we're beginning to see developers look and learn from how developments have been built in Asia. In the UK, we've tended to build office buildings, maybe with a little bit of retail on the ground floor or high streets, but they tended to be single type assets. Whereas it's not uncommon when I visit Hong Kong, Singapore, for these to be vertical. So you can have residential on some floors, you can have a shopping facility on the 13th to 15th floor, a hotel in the building. We're beginning to see developers, and we are also beginning to see the planners start to think about how we create vertical multi-purpose buildings. We're working on one at the moment in the city where there will be residential, there's a hotel element to it, there's an office element to it, there's a retail element to it. So I think that we're going to see developers actually flexing to suit what we're now seeing post-COVID, because clearly a single office let building on 20 years worth of income, as both Ben and Charles have said, is probably a thing of the past. So they're looking at how they multi-purpose those buildings. And what that is also fueling is very much the government and the planners' desires to create more residential and to create multiple areas where there are essentially multiple functions that feed off each other. There's no point having retail sat along in one place, but there's no offices, there's no residential, there's no other infrastructure that supports that retail element, which is why I suspect, Ben, you're right, not many people are lending on shopping centres because they tend to be out of town and don't have the conurbations that you now need to service that. So I'd be quite interested to know what Charles is seeing in that space, because you touched on it earlier.
Charles, do you have a brief comment on that? And then we've got two more questions before we close.
I think you're totally right. Residents or buyers of property want more from their building, and developers are realising that is the way the market is going. There's some very exciting projects coming in the core market and the prime and super prime space. Developers are looking at either linking up with hotels, offering co-working spaces, which are done exquisitely. One development which is coming up has a full array of well-being facilities. You can go and get a potassium drip before a marathon or after a heavy night. You can go in and have a full MOT of your body done on your doorstep, allowing for people to buy probably smaller, more efficient spaces in a building that offers far more than a traditional residential building. And yeah, I think that is a very exciting way the residential market is going.
Terrific. Two questions to finish. I'm going to bring Ben and Martin in on this. Question from Carl Huckstep, just asking, how easy is it for foreign national to obtain a loan on HMO property? What about the LTV earnings parameters? Ben, perhaps you could give us a sense of how you'd start assessing that.
Yeah, so we don't finance HMOs typically in the private bank, but we certainly do across what we refer to as our retail bank and our corporate bank. Typically HMO properties, they are looked at in closer detail because there's obviously a license and a regulatory aspect to it. And in that, I mean, the license to operate one and adhere to all council regulations, etc. They tend to be what I would akin to almost starting to become operational real estate, where they are roll your sleeves up. They're quite granular. They typically are low value, and not in necessary prime locations for those reasons. But they also tend to, what I would say is, therefore trade very well throughout the cycle. You tend to have good occupancy, demand is strong because of that price point. You have, private and public in terms of sources of occupants. So it's a well-trodden path now. Leona touched on previously alternative asset classes that are becoming, anything but, and I wouldn't for 1 minute suggest that HMOs are in themselves institutional. But if you think about the private rental sector, which is now becoming institutional, the private rented sector is effectively a professional almost version of an HMO. So, I think there is a good quality of liquidity for HMO. It is not for every institution. Barclays would be, cautiously keen to take a look at something. LTVs are probably not the most aggressive on them. But as I say, in terms of potentially putting myself in the equity shoes, cash on cash returns are probably very healthy.
Okay, thank you. Martin, just zooming out from HMO and just looking generally at high net worth clients arranging debt and banking in the UK. I mean, your team specialises in dealing with clients in the region. Perhaps you could give us a sense of new clients coming in looking for lending. How do you kind of assess and take on clients from overseas?
Yeah, so most of the clients that we start to deal with aren't existing clients of ours, tend to come from introductions. So it tends to be an introduction from an existing client of ours who has a friend or a colleague or a family member who's looking for property in the UK, or it tends to come through our network of contacts within Asia or other specialists who deal in that area. So everything's about relationships as far as the private bank's concerned. So it's just to get to really understand who the clients are, what they're looking for, what their situations are, and if we can help within the private bank, great. If not, then that there are other parts of Barclays that would be more than happy to have a look at that. But everything's built around just an understanding of their objectives and what their longer term views would be.
Great, thank you. And finally, a question from Michael Smethwick, who I know works in the insurance sector, just asking about panelists recommending clients to deal with IHT problems on residential. I mean, Martin, you're not a tax specialist, but are you seeing the use of insurance and debt as part of the IHT planning becoming more common in the market, obviously in conjunction with legal and tax advisors?
Yeah, absolutely. I mean, just to use Leona's caveat, I'm absolutely not a tax advisor, but it's become more common just because the amount of various structures that you could use previously for UK property to avoid IHT have one by one been closed off by the Inland Revenue. So a lot of it really comes down to the domicile of the individual that's buying the property. But the three key ways people tend to mitigate IHT against UK property assets are through debt. So provided it's put on the property at the point of purchase, getting the highest loan to value possible and maintaining that balance is important. Insurance has become the most common way I personally see of people dealing with it, simply because the revenue aren't ever going to legislate against that, because it means they're still being paid the tax bill at the end of the day. So there's various ways people do that depending on their domicile, but there's been, especially across Asia, a large rise in universal life policies being used, where it's set up by an offshore trust, and then the family can make a decision in the event of the death of the property owner what they want to do with the proceeds from that, whether it is ultimately used to pay off the debt and the IHT bill in the UK, or whether or not the family maintains the property and uses those funds for something else.
Terrific. Well, we are out of time. Thank you for joining us today. Thank you to the panel for a very insightful and interesting discussion. Thank you to Barclays Private Bank for sponsoring this 5-part series. Replay of this discussion plus the other 4 sessions will follow around to all registered, along with contact details for the panelists, so that you can reach out and find some opportunity to do business together. So I would just like to say thanks for joining us, and I wish you a good day.